If you are a business owner deciding between Netherlands and Dubai, this video is going to help you do that. I'll show you how the corporate tax, the personal income tax, the VAT, and the capital gains tax compare between Netherlands and Dubai's tax system, so you can decide which country gives you more freedom to grow your business. Before we start, my name is Shiraz Fahid, and I have helped hundreds of entrepreneurs and families move to Dubai, set up their business, and reduce their taxes legally. And if you want my help in doing the same, you can book a strategy call with me at setuphero.com/call. In the Netherlands, taxes can be a heavy burden on individuals and businesses alike. Personal income tax rate can reach nearly 50% for high income earner, which significantly reduces your take home pay. Corporate tax rate starts at 19% but can climb to nearly 26% for profits above a certain threshold. On top of that, VAT in Netherlands stands at 21%, which affects the cost of goods and services and can impact your bottom line. The compliance burden in the Netherlands is also considerable, with strict filing deadlines, complex audits, and numerous reporting requirements. Residency tie rules can make it difficult to break free from the Dutch tax obligations even if you relocate abroad. And exiting the tax system often requires a detailed plan to avoid unexpected charges or exit taxes that can affect your finances. Dubai, by contrast, offers a more tax efficient environment for both individuals and businesses. There is no personal income tax on salaries, wages, or freelance earnings, meaning every dirham you earn stays in your pocket. Corporate tax rate is at 9% for profits above 375,000 dirhams annually, which is around 95,000 euros. And that is significantly lower than the rates in the Netherlands and applies only to larger businesses. VAT in Dubai is a modest 5%, meaning your day to day expenses carry a lighter tax burden than in the Netherlands. Compliance in Dubai is also simpler, with fewer reporting requirements and less frequent audits. Residency tie rules in Dubai are more flexible, making it easier to establish tax residency and benefit from the city's business friendly environment. Free zones in Dubai offer even more advantages with 100% foreign ownership and simplified corporate structure that can help you grow your business efficiently. Capital gains tax is another key difference between Netherlands and Dubai. In Netherlands, capital gains tax can vary depending on your individual circumstances and the type of assets you hold. For high value investments, this tax can be between 30% to 49%, which can eat into your returns and make it harder to build wealth over time. In Dubai, there is no capital gains tax, so your investment can grow tax free, providing you with more opportunities to reinvest and build your portfolio. This difference alone can make a significant impact on your overall financial situation, especially if you are an entrepreneur or an investor looking to grow your assets in a tax efficient way. Compliance is another key area to look at. In Netherlands, the tax authority have a reputation for thorough audits, frequent filings, and high level of scrutiny. Even small mistakes can lead to penalties, and the complexity of tax code means that professional advice is often necessary just to stay compliant. In Dubai, the compliance process is generally more streamlined, with fewer filings, less frequent audits, and more business-friendly approach from the authorities. This means that you can focus more on growing your business and less worrying about paperwork and compliance issues. Residency ties in the Netherlands can also become a challenge for those looking to move abroad. The Dutch system takes into account factors like your home, family ties, and economic interest while determining your tax residency. This means that even if you spend most of your time outside the Netherlands, you could still be considered a tax resident and liable for Dutch taxes. Dubai's residency rule, on the other hand, are clearer and more straightforward, making it easier to establish your tax residency and benefit from the city's favorable tax regime. Exiting the Dutch tax system can also be a complicated process. Depending on your assets and financial situations, you might be subject to exit taxes or other charges when you leave. This can affect your ability to plan for your finances and make the most of your move abroad. If you have decided to move to Dubai and become a tax resident, there are a few key steps you need to take. First, you will need to set up your company with the right free zone or mainland structure. Then you must apply for the correct residency visa and Emirates ID. After that, you can open a bank account and register with the appropriate authorities. Finally, it's crucial to ensure that your business is properly structured from day one to benefit from the Dubai's tax advantages. This structure helps you protect your income from high taxes, avoid double taxation, and position your business for growth in a tax efficient way. So, if you want my help in setting up your Dubai company, residency, and banking, and exiting the Dutch tax system, you can book a strategy call with me at setuphero.com/call. We'll go through your situation and build a clear action plan that works for you. And if you're serious about using Dubai for your business, you should really check out my next video right here.